How does he manage that message going beyond spring into the summer?
Well, thanks for having me. I think overall he did a nice job of managing the message. Really, I think the important thing here is that, we're having a technical adjustment in reserves, which is going to allow for more efficient transmission of monetary policy. That's really all that's happening here. So we've seen reserves, as of December increase by about $250 billion. They're probably a little higher than that now. And that's resulted in calming of money markets after the kind of episode of stress in September. It's also, put downward pressure on the Fed funds effective rate, which is what the Fed wanted to do to keep it within, the middle of its range. So I think what the Fed has done has been effective. And as a result of that, it can sort of wind down these programs. It doesn't need to continue to add reserves. It just needs to add enough for the efficient and effective monetary policy transmission.
And Tiffany, as we know, he was asked continually about whether there's any connection with that balance sheet operation, buying T-bills, and what is happening in risk assets. The Fed is trying to be really clear, at least for Chairman Powell, not for Kaplan, that there is no link. And I just wonder how they deal with that in the coming months, because there are many people in this market still that believe there is a connection to the balance sheet operation and what is happening with risk assets.
Yeah, I think you have to be careful with that. I think you have to look at what the Fed is trying to do. And really what they're trying to do is they're trying to reduce, bank balance sheet costs. They're trying to reduce or increase liquidity. Now, you can actually look at measures in the market. I don't want to get too wonky here, but those measures in the market, in the bond market at least, have suggested that they have been successful. Balance sheet costs have eased. But then if you go on to riskier portions of the market, high yield or even equities, you don't really see obvious evidence that that's happened. And what I will say is that, although lower bond yields, because equities are discounted with a risk-free rate, lower bond yields should impact equities. The magnitude of the impact is likely very small. And if you look at equity risk premiums, which are investors' demand for yield above risk-free rates to get into equities, they don't appear to have reacted to, the Fed's measures at all. They appear to be reacting to, amelioration of trade tensions, and other factors. So, we just don't see a lot of evidence that it has had a big impact on risky asset markets.
Tiffany, I want to round things out with a conversation about inflation. Seems to be where the focus is for economists following the news conference, following the statement. The reaction function has shifted at the Fed quite radically over the last 12, 18 months. The message is now that if things get worse, we'll be there for you. If things get better, we won't cap the upside. It just feels like before the review, the strategy review is complete, that it's already bleeding into the reaction function. And we saw this in the statement, this symmetrical objective around inflation now. There's just a few people who are starting to think, is the Fed paving the way again for another big dovish tilt? What are your thoughts on that, Tiffany?
Yeah, I think there's as with everything, I think there's some nuances here. Now, I would say this. I think that the Fed is certainly willing, or at least most people are, to tolerate some above target inflation if it were to occur. I think what the discussion is, though, and Powell alluded to this, is around average inflation targeting. Do we want to be so aggressive as to move to that? Because what that implies now with inflation that's running below target is that they actually need to ease when if everything's okay, they still need to ease. To try to get that inflation above target. So what that means is trying to push down the unemployment rate even further, and you might have to take on some financial stability risk. I'm just not sure that some of the FOMC members are ready to do that. I think Fed Governor Brainerd is a pretty good bellwether, and I think she's actually maybe come out against such an aggressive policy. Yeah. But I think it's certainly being discussed, and we'll have to see. But I think one more point on this is that, if growth does, start to disappoint, I think the Fed is going to certainly be more reactive to that, given that inflation is running under target. And that's why we think the bar to cutting is much lower, than the bar to hiking at this point.